Hello, good evening, everyone, friends. Thanks for joining us today for this webinar for what is a discussion on a very, very exciting new opportunity that we are pleased to make available for Indian investors. As you guys may have seen over the last 2-3 years, we at Axis Mutual Fund have been taking progressive steps to make more and more interesting uh, global product offerings available to our investors and partners over the last 2-3 years. And it's been our belief that over time, global investing will become a very key part of all investor portfolios. Why are we so bullish about this, and also to talk about details about the product? That's the objective of today's webinar. We're also very happy to have our colleague from Schroders, Gavin Marriott, who's going to be talking about the specific fund as well. But before I request him to join, let me start off by just talking a few minutes about just the global opportunity and why this is such an interesting thing for investors to look at. We have a brief presentation for today's webinar to just share those slides with you guys as well. So basically, if you see, global investing has a lot of benefits for the investors, but broadly speaking, those benefits can be bucketed into broad areas. One is that it allows us to broaden our investment universe. What do we mean by universe? Essentially, today, if we invest in any Indian equity product, it could be large cap, mid cap, small cap, it all ultimately invests into the Indian markets. And Indian markets, as we know, while we have thousands of listed stocks, ultimately we can invest that only in a few of the quality names, maybe a few hundred or so. So as investors, if we want to expand this and invest in other opportunities, how do we do that? And global allows us to do that. It allows us to expand our universe, look at other ideas, look at other opportunities. The corollary of that, which is the second benefit, is that therefore by diversifying, by broadening our universe, it helps us mitigate or reduce our overall risk in our portfolio. And to combine these two things together, that's what leads to an improved risk-adjusted return for investors. When you talk about the global opportunity on the next slide, it also is something that is not just about just the normal growth stocks or the normal, multi-sector stocks that we typically see in any portfolio. These can also be done through thematic products. And essentially, thematic products such as the one that we're talking about today are very exciting also because these are themes which are normally not really available to the Indian markets or the Indian investors, because themes like disruption and innovation have companies which are unfortunately not really listed in India. With this context, I'm very happy to request Gavin Marriott, who's part of the Schroders Global Equities team based out of London, who's agreed to join us today for the webinar to talk about this really exciting opportunity that we have, which is disruption and the innovation that results from this disruption, and how investors can participate and benefit from this. So, Gavin, over to you to talk about the opportunity.
Ashwin, thank you very much, and good evening, everyone. I'm delighted to be with you today, and I hope you're staying well and safe. On the next slide, we've just outlined why disruption is a very important investment theme for us, and the significance both to the way we live and work, but also as a powerful investment theme that can drive returns. First of all, if you think about disruption as from the perspective of how it affects our daily lives, we see it across every aspect of our daily lives in terms of the way we work, the way we're conducting this conference today, for example, probably would have been inconceivable a few years ago, but the way we also consume media, typically digitally online, the way we shop, and the way we also think about entertainment. All of these areas have been disrupted by technology, and that technology and innovation is taking place at an increasing pace, and the way in which companies are disrupted and competitive landscapes changes are increasing at a rate today much faster than we have ever seen at any time in previous years. So we think that disruption, is pervasive. It is all around. And the point about disruption from an investment perspective is, as I say, it changes competitive landscapes. And as investors, that's critically important, because what we need to understand is not what's happened in the past, but what is going to happen in the future. And if we identify an area where a competitive landscape is being challenged by a new entrant, a new business model, or some element of technological innovation, that has significant implications for company revenues, company profits, and company cash flows. And we need to understand that and try to exploit that in terms of ensuring we are correctly positioned to benefit from that disruptive pressure. If we turn to the next slide, why is disruption happening at such an incredible pace today, and what has changed? And really, what has changed is the power of technology across a number of different aspects. Connectivity, for example, but also memory, processing power, the availability of software. All of these things have converged in the last 2, 3, 4 years, and really providing very, very important tools for companies to really utilize that technology to develop new product offerings, new ways of doing business, and in doing so, change, as I say, the competitive landscape. And this strategy is all about change and focusing on the changes that come from innovation. If you look at the next slide, we've seen through the COVID crisis increased momentum in the disruptive pressures that were already in place, but perhaps not quite so visible as they have become in the last 12 months or so. And I'm thinking there particularly about the use of technology in our working practices, the fact that we are increasingly working remotely and reliant on cloud computing, cloud-based software applications, the importance of connectivity, whether that be through the internet or through 5G applications, and also in terms of the way we have spent our leisure time, the greater reliance on online shopping, for example, the importance of video streaming and these digital platforms in terms of keeping connected to family, relatives, and friends. These have all become much more important over the last 12 months, and really have found a momentum because of the COVID vaccine. The question is to what extent these changes in the way we live our lives will be sustained, and whether these are structural and will be with us for years to come. And our belief is that disruption is going to be an ongoing part of our lives over the next decades to come. On the next slide, the way we think about the opportunity for this fund and from disruption generally is to think from a top-down perspective, where we see the greatest evidence of disruptive pressure leading to change. And from that analysis, we've arrived at 9 areas where we think disruption and change is pronounced and particularly significant. And this allows us really, or creates a framework then for us to identify stocks that are positively or negatively exposed to that disruption. If you look at the 9 themes that you see, sub-themes that you see sitting within the fund on this slide, some of these areas of disruption will be very familiar to you and actually have been in train for some years already. E-commerce is the obvious example, and if you think about Amazon as the poster child for disruption, Amazon has been disrupting industries and businesses really for the last 15 or 20 years and has grown very, very rapidly indeed as a consequence. But yet we are still only in the very early stages of the growth potential that comes from e-commerce and disruption in that particular sphere. If you take Amazon, for example, they reported their results 2 days ago, and their results again were absolutely astounding in terms of their ability to drive growth and find new avenues to generate revenues, and in turn drive profit growth, due not only to its strong position within its home market in the US, where e-commerce penetration is quite high, so somewhere in the region of 20 to 25%, but that shows you the potential for e-commerce to grow still further, but also in terms of its international operations, which are in many respects nascent and only really at the start of really an exciting journey. They also have the ability to disrupt different industries and extend and broaden out their offering from current merchandising into areas such as the provision of healthcare, and into food distribution as well, which is again a part of their growth story. But it's not just Amazon; it's companies like Sea Limited, the Singaporean listed stock that is developing the same operating structure in markets such as Indonesia, Vietnam, Taiwan, again, which has a very, very significant addressable market and probably is, 5-10 years behind Amazon, but with the same sort of growth potential. Mercado Libre in South America, again, which is an Amazon equivalent, selling into markets such as Brazil, Argentina, and Chile, again with a similar growth potential. So e-commerce very, very firmly established, but still very exciting nevertheless. Fintech also would be one of those areas which has already seen disruption, and you will be very familiar with the disruption that fintech has introduced in our industry. But again, we are still only partway through the journey, and last year alone we saw 3 mega mergers of the large payments companies that were forced into merging because they saw the pressure being exerted on their businesses by some of these younger, smaller startup fintech companies, which have software packages which are much better aligned to the needs of small, medium-sized businesses and online and the online economy. So these are well-established trends. Elsewhere, you see emerging trends, and I guess healthcare is quite surprising in that healthcare actually has been quite slow to embrace technology and technological innovation. And because of that, actually, the development of drugs and healthcare products has been held back because there has been this inability to really leverage the both the science but also the technology that increasingly will be more important on a forward-looking basis. And the development of the COVID vaccine, for example, is an example of how technology innovation has created new products, new opportunities, and the very, very rapid development of the COVID vaccine in somewhat less than 12 months, where previously that same vaccine development program, without the gene and cell-based technologies that are increasingly being used today by the likes of Moderna and BioNTech, would have taken something more than a decade to design and develop and deliver. So healthcare is starting to embrace that, the use of technology, new companies coming in with software-based solutions, digital solutions that will help us monitor and manage our healthcare needs, but also in terms of the development of new applications, robotic surgery, cell and gene-based technologies that really are state-of-the-art and will transform the treatment in that particular area. So healthcare is emerging. Environmental is also another area of significant disruption. Actually, disruption there not just as a result of technology, but also as a result of changes to regulation, which again are disrupting the established markets and established players and creating change that creates opportunity for companies and investors. So these are the 9 themes we use. We are constantly looking for new areas of opportunity, and there is a dynamic rotation across these themes. But when we look within the themes, we find typically 3 distinct opportunities, and these are shown on the next slide. The first opportunity is those companies that are disrupting industries. These are the new entrants who are disrupting an industry, or sometimes creating a new industry from a new product, a product innovation, or a change in a business approach, which is resulting in beneficial outcomes for the consumer or end user. So the disruptors are the guys who are really coming in and taking market share quickly, or gaining market share quickly from the incumbents because of the innovation that they are bringing to the market. As I say, Amazon would be a good example of that, but you could extend that to companies like Spotify, for example, the online aggregator and owner of music licenses, which allow us to consume music, podcasts digitally by subscription. Netflix, which is doing the same on-demand TV and film services, which continues to see very, very significant growth and has a very, very sizable addressable market to grow into. So these are all examples of disruption, use of technology to really make the way we consume content in a much more efficient, effective, enjoyable fashion. The second category on this page are the enablers, and think about the enablers really as the infrastructure providers. These are the companies that are providing the component parts that are necessary for the disruption to take place. So if you think about the shift to automation, digitalization, a lot of that is reliant on semiconductor chips, memory, sensors. All of these component parts are provided by a group of companies that may well not occupy the limelight and enjoy the labeling of a disruptor, but they are certainly contributing to that disruption and benefiting from that disruption in terms of increased demand for their products or services. So typically we see as I say, the technology companies sitting within this bucket, the software companies sitting within this bucket. Think of them as the bricks and mortar that allows the disruption to take place. And then the final area of opportunity are the adapters. These are the incumbents within an industry that already enjoy a strong market position and potentially have enjoyed that strong market position for a number of years. But these are the companies that are seeing some disruptive pressure from innovation or new entrants that they need to adapt to. Now, the successful adapters will be those companies that recognize the disruptive pressure and radically change their business to ensure that they can sustain a level of growth previously enjoyed and protect their existing client base. A great example of a company that has adapted in the last couple of years would be Walt Disney in the US, that really was very early to recognize the pressure being exerted on its business from different forms of media. And what they realized is, although they owned a lot of valuable content, they didn't own the delivery of that content. It was typically delivered through different platforms. And what Walt Disney have done over the last 2 years is radically transform their business, taking content off the established platforms and delivering it directly to individuals, allowing them to better monetize that content and keep control of the use of their valuable proprietary content for years to come. And the shares have responded to reflect that much more optimistic growth outlook. There is a fourth category on this page, which is shown on the right-hand side. These are the deniers, which would typically be, again, those large actors within particular industries that either fail to recognize the disruptive pressure or fail to do something about the disruptive pressure in the belief that they can carry on in the way that they have always operated, with the same product lineup, with the same business model, and in the belief that they can continue to grow. We've cited here Nokia as a good example, which really was a business that was slow to recognize the pressure coming particularly from Apple, but smartphones more generally, and very quickly found that their prominent position in mobile phone handsets was quickly eroded, and really the company is a shell of what it once was. Clearly, our fund, we are trying to ensure that we have no exposure to those deniers, and that we're really focusing on the three buckets to the left-hand side as opportunities for growth. With that, I'll pause and pass back to Ashwin, but thank you for your attention.
Thanks a lot, Kevin. And before I go further, just a couple of quick announcements that we have made provisions for you to ask questions to us. Anything that you have on the question, on the fund, on the strategy, please do reach out and type it out. And we also will be asking, we'll be having some questions coming through for you guys as well through the webinar to take advantage of that. On the product structure itself, this is a fund of fund structure. So the way this works is just like any other feeder fund. Any investor coming in into the fund in India would be buying units of the Axis Global Innovation Fund of Fund. That's the fund that we are launching here in India. And the money that the Axis Fund collects, we will be deploying that into the Schroeder Fund, which is the Schroeder Global Disruption, which is essentially based out of Europe, but deploys its money all over the world. It is a global fund. So that's the important thing of the structure in terms of Schroders. When you come to global investing, you have to keep in mind that you need a really strong partner, somebody who can really understand and invest at a global level. And Schroders offers us that capability they are one of the largest fund managers in Europe and manage well over $600 billion in assets and have capabilities all over the world. that's the one of the questions we also get is the because there are multiple global funds that we have done, how would this fund that Gavin just described, which is the disruption strategy, and the Access feeder fund, which is the Access Global Innovation, how is that positioned vis-a-vis some of the other global funds that we have launched? And what I would highlight here is think of it like, as I've said maybe in the beginning as well, in the Indian market also, we have a number of different products to access the Indian equity markets. We have diversified funds, we have thematic sectoral funds, thematic funds, large cap funds, multi cap funds. So the idea is that every Indian equity fund is not the same. They may have a few stocks which are similar, but essentially the mandate decides whether they are similar or not. And it's possible to design different funds with different mandates. The same thing holds true for global funds as well. In the case of the Access offerings, if you see, we have a very prominent global product already on the platform, which is the Access Global Equity Alpha Fund of Fund. That fund is essentially a large cap best ideas, a diversified product, which can invest across different sectors, across different themes, essentially on a bottom up basis of trying to identify the best high conviction companies to include in its 40-45 stocks in the portfolio. When it comes to the new offering, the Global Innovation Fund of Fund, this is not a fund that is trying to pick best stocks from all different themes, but it's trying to position itself very sharply into this specific theme, which is basically related to disruptive change and innovation, which is leading to winners and sharp growth potential, which the winners have, they can potentially realize over the foreseeable immediate future. And really, therefore, as Gavin has already highlighted, there are specific sub-themes that the fund manager has isolated, which include, as Gavin explained, things like fintech, e-commerce, biotechnology, environment, totally 9 themes. And therefore, you're really focusing on these themes and trying to pick stock within those themes. So it's not a go anywhere. It's not a diversified strategy, really sharply positioned. And therefore, what does this do for the investors? The idea is, just like for investors, you need funds which are more diversified, more stable in nature, which can run on a more stable basis, closer to what the broader markets will do. That's what diversified funds do, of course, with the alpha potential. But thematic funds really are able to, because they are more sharply positioned on a specific theme, have the potential to deliver much higher levels of alpha, because if they can get their stock selection right, and if they can play the right ideas, and if the theme plays out as per the expectations, then really that product can really capture the upside in a very sharp way, which perhaps any diversified fund may have a small exposure, but because it's a smaller exposure in a broader portfolio, may not capture in the same way. So to compare and just to summarize, a global alpha is more like a diversified large cap product. A Global Innovation Fund of Fund is more thematic, focused on the disruption theme. And in that focus, looking at ideas, it could be large cap, mega caps, but also has the ability to buy mid, small caps within that, so that you get the best possible ideas within that portfolio for that. With that, we have come up with the end of this introduction, this presentation that we have. And we'll use the remaining time to answer a number of questions that we've already received. Like I said, we will be very, very happy to answer as many questions as we get. So please use this opportunity to type out any questions that you may have for us. I'll start off with a very relevant question for Gavin. And Gavin, the question is, of course, we know that COVID has created a very positive tailwind for some of these transformational, processes and ideas over the last 18 months. Is there a risk that once the world moves out of the whole COVID crisis, that we could see a certain amount of reversal in terms of some of the changes that we have seen? And could that be some kind of a headwind for this strategy going forward?
Mm. No, it's a very relevant question, Ashwin. I definitely don't think you will see a reversal of the trends that we have seen accelerate through the COVID crisis. The world has changed, I think, forever in many respects. But actually, the COVID crisis has introduced habits that once formed are difficult to change, and we have seen that. We've seen that with online shopping as being one of the areas which continues to see growth, and certainly the growth accelerated during the COVID crisis. And there may be the chance that growth will slow over the next couple of quarters, given the strong comparisons that are being made with growth seen last year. But actually, the trend is for strong growth over multiple years to come. So with companies like Netflix, for example, which would have been a good example of a stock where demand was certainly brought forward by COVID. If you were thinking about subscribing to Netflix before lockdown and the virus really took hold, you were likely to have made that decision at some point last year. So that element of the market would certainly have brought forward their decision to subscribe. But actually, if you look beyond that, and you look at the total addressable market potential of Netflix, they still have a massive runway for growth. So maybe 1 or 2 quarters where the growth overshoots the trajectory of last year, but I think very, very strong in absolute terms, particularly relevant to say some of those incumbents that are really under pressure from these new business models.
Very well put, Gavin. And we have this whole experience for us closer home in India as well, where if this webinar is a great example of something that we are using Zoom for, and once you see the convenience of a webinar and the fact that we can do so many meetings through video calls, definitely, even if travel starts post-COVID, will we stop using webinars or video calls? I would think not. And that's the whole power of technology, because we do have progresses. Sometimes the progress happens faster. Sometimes there are dislocations which create the breeding ground for progress, but we don't really go back. Once you've got a smartphone and you start using WhatsApp or messages, you don't stop using that. Even if the trigger for that was something else. Coming to a more specific question on the portfolio itself, Gavin, how do you see the market cap breakup in a strategy like this? On the one hand, you have the mega caps, the very, very well-known names like Amazon that you named yourself, and Netflix, some of the really sort of marquee big giants, but you also have, on the other hand, some upcoming new disruptive names which could be maybe mid to small in size. And how does the fund try to sort of balance out this whole thing? And if your thoughts on that piece.
No, I think you were right in the way you summarized the difference between this fund and the Global Equity Alpha Fund, in that this fund really should be and is all about trying to obtain exposure to those smaller, fast-growing companies that perhaps currently fall off the radar of some of the mainstream core global equity products, such as Global Equity Alpha. So over time, I would expect this to have a much more significant skew towards mid-caps, and some of those smaller cap names. But nevertheless, we do recognize that there is a benefit in holding some of these mega cap stocks that will just keep delivering and beating the market's expectations. So we unashamedly hold the likes of Amazon, Tencent, Facebook, which are mega cap stocks, but continue to benefit from this growth as a result of their disruptive activities and ongoing innovation. The reason that perhaps today, if you looked at the portfolio, we probably own slightly more of those larger cap names than you might expect on a 3-year view, is because we are definitely at a point where the valuation of some of these hyper growth small and mid cap names is very, very extended relative to some of these large mega cap names. If I look in technology, a number of the smaller names that have just IPO'd or are at a very early stage of their growth, the multiples that you are having to pay to gain exposure to them are significantly higher than multiples you would pay for slightly less growth potential, but nevertheless strong growth from some of the larger and mega cap names. So there is a bias towards those larger names at the moment, but that is simply a function of valuation and our belief in terms of how we are going to maximize the returns of the portfolio.
Great, and your point on valuation is something that I would just pick upon again, because we have a number of questions related to the fact that we've seen a pretty frenetic rally in this theme over the last couple of years, again because of COVID, and by many accounts the valuations are quite rich in this space. And how do you see valuations currently, and do you think does that present a risk for investors as they come in at this stage?
Well, we're certainly trying to protect investors by thinking very carefully about valuations, and where we think valuations are difficult to justify, then we have the option within this particular fund to sell out of the name and take profit. So we're not required to hold any name that we don't believe is fairly valued or represents a store of potential value going forward. And I think the concerns around valuation, particularly in technology, have been a cause for the sell-off that we have seen in technology over recent weeks. And actually, some of those technology names, which do have very, very powerful, strong growth drivers, have sold off very, very considerably over recent weeks, and actually now represents a pretty attractive entry point if you believe the long-term growth potential of those companies. But I think you're right. It is one to be cautious of, and when you're investing in growth-related companies, what we have to remind ourselves all the time is that there is a price for everything, and you need to align that price to reasonable expectations of forward-looking growth, and that's what we come back to every time we make an investment decision. So caution around some of those inflated areas. We just won't have exposure to some of those stocks, but actually much more prepared to invest when we believe that there is a strong long-term growth opportunity that hasn't been recognized fully by the market.
Absolutely. And from my side, I will just add here that ultimately this is an equity product, and like all equity products, you do take a certain amount of market risk in terms of near-term market volatility, which always is a risk whenever you invest. So as we always recommend for any equity fund, we've done it for the domestic funds in terms of seeing if you can make regular investments, have a reasonable horizon, don't try to time markets too much. I think some of those same sort of sensible approaches can help us a lot in terms of navigating this theme as well. This is what we believe is it's a secular, more long-term theme that we are trying to play here. It's not about what the markets may do in the next 3 to 6 months. So please do look at this as a more long-term allocation, as a more structural allocation. And if you do make regular allocations, you should be able to manage any near-term ups and downs that the markets may see as well.
I think you're sorry, Ashwin. I was just going to add. I think your point about time horizon is really important, actually. And whilst I'm sure over the next 6, 9, 12 months we are going to go through some volatility, I think there is a support market to continue to rise, and these stocks should benefit. But actually, if you're prepared to take a term view and have a longer term time horizon, I think if you were to buy this portfolio today and come back to it in 5 years time, actually this would look a pretty cheap portfolio, because actually the earnings would have carried on accelerating, and you're buying what are today actually incredibly cheap stocks based on a sort of 5-year realistic forecast of earnings.
Absolutely, and that's what we're offering to the market, which is really a potential for above normal growth because of the structural tailwinds that this theme provides, and essentially, as we've seen even in India, that growth typically does not come cheap. The market does put a premium to growth stories, and sometimes that premium is justified if the growth does come through as per expectations. We're getting a few questions around currency and currency risk, so I'll just try and quickly summarize how that works for this fund. The Indian investors invest into the Indian fund of fund, which is in rupees, of course. And what we will then do is invest the rupees. We will convert them into US dollars and invest into a US dollar denominated share class of the Schroeder fund. The Schroeder fund, of course, is global in nature, so they use the money that they collect within their fund and deploy them in different markets as per whatever the currencies of those markets are. So to the extent that the money gets deployed in the US, it has US dollar exposure. It may get deployed in euro or Chinese yuan or Japanese yen. So, of course, as a global portfolio, there is a bunch of different currencies that you get exposed to. Ultimately, that's part and parcel of the analysis that the fund manager does when they're trying to take an investment decision and trying to come up with a holistic view. From an Indian investor's perspective, the key risk is what happens to the rupee relative to the major economies, the major currencies. And over a holding period, what we like to believe is that the impact of that movement should be a very small one relative to the potential return profile of this product. So yes, currency can play a role in the short term, but being an equity product, and that to a growth-oriented product, we would not really look at ask people to look at this from the prism of currency. At the margin, it may add or subtract a little bit, but that will not be material to the overall scenario for the fund. One question in terms of Gavin here is in terms of the tail of the fund, and there are people we've seen in terms of the fund construct that we look at about 110 stock positions in the portfolio. So thoughts in terms of is that a fair number? Is that too many? They've also some observations around the incubation piece, which is the smaller piece where we have a much smaller weighting for the longer tail at the end. And just in terms of how you see that, and what's the rationale for having that structure in the fund?
Well, the two, as you rightly point out, are related. The tail of the portfolio really reflects two things. It reflects, first of all, the desire to hold a large percentage of the fund in some of these smaller and sometimes less liquid names in the portfolio. So what we want to do is we want to diversify the risk of some of that, and also make sure that we are managing liquidity so that we can exit those positions quickly. So quite often that means we do have to own smaller position sizes in those less liquid names. But the other feature, I think, and this is, I think, really important in the context of the conversation we were having about valuation and momentum is when you're buying these growth companies, you clearly have a vision about the long-term growth potential. But actually, the long-term growth potential is made up of lots of shorter-term periods where you are either going to receive news flow or earnings data which supports that long-term estimate of growth or actually challenges it. So what the fund manager is doing in managing this portfolio is adjusting the weights of the portfolio, adjusting the weights of stocks in the portfolio to reflect news flow and reflect changes in conviction and operating momentum, which means that he will take smaller position sizes potentially initially when the investment view is emerging and is starting to develop, and then add to those position sizes over time. So what it means is you do have a long tail in the portfolio, as you highlight, Ashwin. Those stocks that are underweighted or subweight relative to the optimal long-term weight, but they are there deliberately at that size, and the intention is to add to those weights as our confidence, conviction, and the data supports that long-term view. So I think the number of holdings is a function of that, managing liquidity, diversifying smaller and mid-cap risk, but also providing the manager with the ability to incrementally adjust and add to position sizes as he becomes much more confident in the long-term growth potential of that stock.
Great, thanks. And just a few sort of more housekeeping questions, which I just try and cover quickly. There's a question on the expense ratio of the fund. We expect that to be, if you add both the levels, which is at the Schroeder level, there will be a 0.75% expense ratio. At the Axis level, about 1.5%. So on a combined basis, about 2.25% is what we expect the expense ratio to be. On the question on currency, one of the questions which I didn't answer was whether there is any active hedging which is carried out. And by and large, that is not the case because these are ultimately open-ended equity exposures. So you don't really worry about, like I said, you try and factor in currency expectations in the stock itself. And at Axis, when we invest, we will not be taking out any currency hedge from our side. There are some questions on the performance of the portfolio. So those details are available in the NFO deck that we have circulated. Please reach out to your contact point in Axis Mutual Fund, and we'll be happy to share those details in specific. But talking about the portfolio, and sorry, before I come to the portfolio on the performance, the fund was launched in 2018, and since its inception, it has delivered pretty strong returns. But I would strongly urge people to keep in mind, because the absolute returns, they look really strong, both in dollar and rupee terms. But just keep in mind that that's happened in an environment that has been extremely positive and supportive for equities. So while, yes, we've had a great start and we think that this strategy has a great future, of course, some of the numbers, if you see the last 12, 18 months, are numbers which are super normal and will normalize as we go forward. Talking about the portfolio, Gavin, some questions around how you see the geography mix or the sector mix of the portfolio. So any thoughts that you can share on that?
So the portfolio is skewed towards the US currently relative to the benchmark index, and I think that reflects that a number of these technology-based companies tend to still be listed in US markets and in many respects domiciled in US markets. Actually, as investors, we're less interested about where companies are domiciled or where they list their equities. It's much more important for us as investors to understand which geography a company generates its revenues from, because again, that's much more indicative of the risk to those earnings or potential for those earnings going forward. I think the the tilt to the US will change over time, and you're probably very aware through your other fund exposures that actually China particularly is a very rapidly developing market for technology-based companies, and many of those technology companies now rival the very best in the US. And as China continues to open up as a market, I think you will see a shift in capital, maybe away from the US towards China, and some of the other emerging market economies. Again, just as market access opens up, but also as these new disruptive technologies and innovations start to emerge. I mean, a good example, actually, outside technology would be Tesla, for example, which Tesla as a stock, which has been hugely disruptive over the last 5 or 10 years, 5 years probably, in terms of its disruption of the auto industry, and is now a company that is facing genuine disruptive pressure from some of these Chinese new entrants that are actually now starting to develop and manufacture and market electric vehicles which really rival anything that Tesla has on its platform. So a good example of a disruptor becoming disrupted, but also the shift from a US listed company to the emerging markets. And again, we're positioned to reflect that with exposures to companies like BYD, for example, the Chinese EV company.
Great. And there's also questions around. So if I could summarize your observations, what you're saying is that, of course, US will be large because of the nature of the stock market and the capital markets and just the ecosystem of startups and technology innovation that they have there. But going forward, I think emerging markets is something that you are watching very carefully, and you do believe that that's a space where allocations could go up, and specifically, big emerging markets like China, which have very, very interesting companies doing a lot of good work in terms of innovation.
And particularly because many of these disruptive businesses don't need a physical presence. They're operating in the digital world, so actually it doesn't matter where they're located. And as global investors, we think the same. It doesn't matter where they're located.
Yes, absolutely. And just again, a couple of quick questions around taxation. So keep in mind that a fund-of-fund structure, a feeder fund structure gets taxed like a debt fund in India, not like how an equity fund would be taxed. So even though this fund is inherently an equity-oriented strategy from a taxation perspective, it will be 3 years of long-term capital gains, less than 3 to get into short-term, and the usual sort of caveats as far as the debt taxation is concerned. There are a bunch of questions on how would we compare performance of a strategy like this with an Indian equity portfolio. To be honest, it's not something that it's a very easy answer, because we do have a lot of good growth potential in India. So we've always been clear, and I would want to re-emphasize that the search for new ideas or new opportunities beyond India is not a search for something to replace the Indian exposure, because the Indian exposure can deliver really well. It's more a search to expand our universe, a more search to expand and find new ideas that can complement what we are doing here in India. And therefore, in separately speaking, we expect the Indian markets to do really well, but also strategies like this have the ability to deliver very strong growth, which is what equity markets ultimately value. And if they can deliver it, that's what we expect these companies to get rewarded by the markets as well. So tough to say a number, because this theme is so new, but we would expect, and that's really our broad expectation, that this theme, if it plays out as we expect, has the potential to deliver substantial alpha to broad global markets. Indian markets also should, because we are ultimately about growth. If we see the growth happening in India, in the Indian markets, will also should have the ability to continue to deliver outperformance to global markets. But having said that, these two strategies can really complement each other, because we expect the longer term correlation between these to not be so high, because one is a more specific, diversified, India specific product. The other one is a theme, and that looks at a global level. So these are two different sort of complementary strategies. Both have the potential to deliver strong growth potential, but in a way through different channels. And that's where the beauty of diversification kicks in, which is why we really are so excited to bring this for all our investors. With that, unfortunately, we have run out of time. Maybe we can take, the last, one question for you, Gavin. And broadly speaking, how do you see, in terms of the themes in this fund, is technology the biggest theme? In terms of the near future, do you see a few themes that can potentially rival or become big, like technology? Just broadly, in terms of the next 6 to 12 months, how do you see that playing out?
I think technology is it's at the center of the innovation and disruption that we're trying to play, and increasingly central to all walks of life. So I think technology is the new staple. In fact, it is not the cyclical area of the market that perhaps it once was. It is an essential commodity, and I think for that reason it has very strong structural support, and will remain a really important area to have exposure to within an investment portfolio. Where I think there are sort of other nearer term opportunities, the other area would probably be in environmental innovation, particularly as we are seeing a massive ramp up in efforts to decarbonize the global economy, and what comes with that is technological driven innovation that will allow us to manage our energy consumption in a much more efficient way, that will bring alternative forms of transportation, of power generation, etc. So that is something that will be in the limelight certainly over the next 3 years, unquestionably. And then the final area, I think, because of the coming back, unfortunately, to the COVID virus, unfortunately, I think healthcare innovation again will be a really, really important area of growth over the next 2 or 3 years, simply because it has to be in order to continue to deliver these new products, to manage cost, and to ensure that a stretched healthcare system can actually meet the needs of the population.
Thank you. And maybe a related point on that is, as themes change or evolve, how do you see the churn or the active management of this fund? Do you expect this fund to sort of move its position quickly or in a nimble manner to realize those changes, or any thoughts on that?
Yeah, very definitely. You will see a dynamic rotation in the exposure to these various sub-themes that will in part reflect valuation, as we've discussed, but it will also reflect where we are in the economic cycle and the investment cycle. So some of these themes, whilst they might be powerful structural long-term trends, sometimes they're great investment opportunities, sometimes they're less good, and we should be reflecting that in our exposure within the fund.
Great. Thank you, Gavin. And just to summarize, thanks everyone for joining. And just to summarize, the Schroders Global Disruption Fund, it was launched in 2018. It has been running pretty successfully for the last 2.5 years. It is a strategy disruption which is very, very new, even from a global market perspective, and we are very excited to bring it here. The fund that we are launching, the Access Global Innovation Fund of Fund, the new fund offer opens up on 10th, which is on Monday. And this fund will invest into the Schroeder Global Disruption Fund as a feeder fund. So that's the structure that we are talking about today. And unfortunately, as I said, we have run out of time, but there are many questions which we could not take up. We would strongly request each of you who have follow-up questions, etc., to reach out to us at X Mutual Fund, and we will make sure that we give you all the materials, whatever inputs that you need to help you on this. With that, as I said, it's very exciting times with respect to this product, and stay safe, be careful, and look forward to your participation and support on this launch. Thank you, everyone.
Thanks, everyone. Stay safe.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.